The global economy may be sitting on top of a financial time bomb, and almost nobody is paying attention. While millions of retail investors celebrate record-breaking stock market highs and endlessly debate the next AI stock or meme trade, a much bigger story is quietly unfolding behind closed boardroom doors. Over the next few years, corporations around the world will have to refinance roughly $2.5 trillion of debt that was borrowed during one of the cheapest money periods in modern financial history. And unlike before, this time, the rules have completely changed. The money is no longer cheap, interest rates are dramatically higher, and a crisis that most people never saw coming could soon begin to ripple through every corner of the global economy. To understand why this matters, we have to go back a few years. During the period after the 2008 financial crisis, and especially during the pandemic years, central banks flooded economies with liquidity. The Federal Reserve and other major central banks slashed interest rates close to zero. Companies everywhere took advantage of this environment. Why wouldn't they? Borrowing money was incredibly cheap. Businesses could issue bonds at 2%, 3%, or even lower rates. They borrowed billions of dollars to expand operations, buy competitors, repurchase their own shares, and boost earnings per share to keep Wall Street happy. For years, this system worked beautifully. Investors were making money, executives were rewarded with stock-based compensation, and everyone assumed low interest rates would remain forever. But then, inflation arrived. Suddenly, central banks had no choice but to aggressively raise interest rates. The era of easy money came to an abrupt end. Now, the debt that companies borrowed years ago is starting to mature. That means these corporations must either pay it back immediately or refinance it with brand new debt. And that's where the problem begins. Imagine you bought a house with a mortgage at 2.5%, but now your lender tells you that your next loan will cost 7%. Your monthly payments would skyrocket overnight. The exact same thing is happening to corporations right now, except instead of households, we're talking about trillions of dollars. For some companies, this will simply reduce profits, but for thousands of others, it could threaten their entire existence. This brings us to one of the most important terms many retail investors have never heard before: zombie companies. These are businesses that generate just enough cash to survive, but not enough to comfortably pay down their debt while growing at the same time. In simple terms, they are financially alive, but economically dead. They survive only because lenders keep extending credit to them. During the low-rate environment, zombie companies multiplied because borrowing was easy and investors were desperate for any return they could find. But today's higher rates are exposing just how fragile these businesses really are. Now imagine thousands of zombie companies all trying to refinance their debts simultaneously. Suddenly, banks become more selective, investors become more cautious, credit standards tighten, every dollar becomes more expensive. The weaker companies start cutting costs, freezing hiring, delaying expansion projects, and laying off employees. Those decisions don't stay inside corporate headquarters. They spread throughout the economy. Suppliers receive fewer orders. Consumers spend less money. Economic growth begins to slow. Meanwhile, something very interesting is happening that many retail investors are completely missing. Institutional investors, pension funds, sovereign wealth funds, and what Wall Street often calls smart money are quietly changing their strategy. For years, they had little choice but to chase stocks because bond yields were unattractive. But now, high-yield corporate bonds and investment-grade bonds suddenly offer compelling returns again. Why take enormous risks in expensive equities when you can lock in 6%, 7%, or even higher yields in debt markets? This shift of capital matters more than people realize. Financial markets run on liquidity, and liquidity is simply the availability of money flowing through the system. If institutional investors begin moving billions of dollars from stocks into bonds, fewer dollars remain available to support stock market valuations. This doesn't necessarily mean an immediate market crash. In fact, markets can continue climbing for months while these shifts happen quietly in the background. But eventually, liquidity starts to matter more than excitement. Think of the global financial system like a giant reservoir. For over a decade, central banks kept pouring water into it. That extra liquidity lifted nearly every asset class at the same time. Stocks surged, real estate boomed, and speculative investments flourished. Now, central banks are no longer flooding the system with cheap money, and corporations are simultaneously trying to absorb massive amounts of available capital just to refinance existing debt. Instead of money flowing freely into growth opportunities, more of it is being redirected towards simple survival. This creates what analysts call a liquidity crunch. It doesn't mean the world suddenly runs out of money, it means there is less money available for risk-taking, expansion, and innovation because existing obligations demand priority. Companies must spend more on interest payments instead of research and development. Banks become more defensive. Investors become more selective. Credit conditions tighten even further. It's a chain reaction that slowly drains energy from the financial ecosystem. What's fascinating is that retail investors often don't notice these shifts until it's too late. Headlines continue celebrating all-time highs in the S&P 500. Social media influencers continue discussing the next hot stock. Financial television networks continue promoting short-term market optimism. But underneath those headlines, professional investors are reading balance sheets, tracking debt maturities, and positioning themselves for an entirely different reality. This doesn't automatically mean a recession is guaranteed. It doesn't mean every company is in danger. Many corporations have strong cash reserves, healthy balance sheets, and diversified revenue streams. But history teaches us that major financial stress rarely begins with a dramatic explosion. It starts quietly. Small cracks appear beneath the surface while everyone is focused somewhere else. By the time those cracks become obvious, the biggest players have already repositioned themselves. So the next time you see another headline celebrating stock market highs, ask yourself a different question. Where is smart money actually moving? Because the hidden $2.5 trillion corporate debt refinancing wall may become one of the most important financial stories of this decade. And while retail investors remain distracted by short-term gains, institutional investors are already preparing for a world where cheap money no longer exists. In finance, fortunes are often made not by following the crowd, but by paying attention to the risks that nobody else is watching.